Okay, welcome back. This is part 2 of the standard costing and specifically the variable cost variances. So I said in the previous video, forget about the fixed costs for now. Just looking at variable costs, and it's because they all are calculated in the same way. And we split each of the variable cost variances into a quantity variance and a price variance using this table. So to recap, the left-hand column is how much should it have cost us to make the actual units produced. The actual units produced in this example is 1,100 units. The far right-hand column is how much did it actually cost us. So it's how much should it have cost us, and we call that the flexible budget. How much did it cost us, the actual number. Then we put in a middle column just to isolate on the right-hand side the difference in price per kilogram, or liter, or hour. And on the left-hand side, we want to isolate the standard quantity used on per unit. So this middle column is called the actual quantity of input at the standard price. So the actual quantity of input comes from this actual column. So that 1,210 kilograms. That was given, by the way, in this example. So if you wondered where that comes from. If it's not given, you'll have to calculate it using the total actual value less the actual price paid. So this actual quantity of input at standard comes from the actual kilograms comes from this side, whereas the standard price comes from the budget side. The standard price is the 10 Rand per kilogram. So for labor, actual hours worked comes from the actual side at standard rate per hour from the budget side. Remember, this is rate per hour. If you work in hours, make sure that the rate is in hours. If you work in units, it's cost per unit. So then for variable overheads, in this example, we assume it's allocated on the basis of labor hours. So labor hours comes from this side, the actual hours, 2,000. You'll see it's the same as labor hours at the standard rate per hour from this side. So now we can see all the variable cost variances. A favorable price variance, because we paid 9 Rand 50, you can calculate that. 9 Rand 50 versus 10 Rand, so we saved 50 cents per kilogram purchased. Favorable variance. On this side, we used more than what we should have used, so it's an unfavorable variance. For labor, initially, remember, in part 1, it looked like we should have used 22,000. We did pay 22,000, so there were no variances, but we can see there, we paid more per hour than what we should have paid, 11 Rand per hour. So that's an unfavorable price variance, or they call it a rate variance. On the usage side, or the efficiency variance for labor, we did work 2,000 hours versus we should have worked or could have worked 2,200 hours. That's 2 hours per unit times 1,100 units. So if you forget which one to deduct from which other one, just ask yourself, if we use more hours or less hours than what we should have worked, it's good. If we work more hours than what we should have worked, it's bad. Then it's unfavorable. So indicate the F for favorable or U for unfavorable. Then, if you don't get any variance, like in this case, 30,000 less 30,000, don't be surprised. It's just because there were no variance. The actual rate was 15 Rand per hour, and the standard rate was 15 Rand per hour. So in the next clip, we'll go to the fixed overheads.